On June 17, 2026, global financial markets were thrown into total blindness. For over a decade, Wall Street operated on a single, unwritten promise from the Federal Reserve: predictability. But in a single press conference, the newly appointed Fed chairman did the unthinkable. He turned off the headlights, triggering a brutal algorithmic liquidation that dragged Bitcoin straight below $64,000. This wasn't a standard market correction. It was a deliberate regime change, engineered by a man who believes the central bank has coddled investors for far too long. Welcome to Block Docs, where we strip away the noise to expose the raw truth of crypto and global finance. Hit subscribe to track the money with us, and let's get straight to the story. To understand why your portfolio just bled, we have to look at the massive illusion built over the last 3 months. Markets were riding high on euphoria. In Switzerland, Washington and Tehran had just signed a historic geopolitical agreement, immediately easing tensions, opening up crucial trade routes, and sending the S&P 500 up 1.7% to record intraday highs. Investors assumed the macro risks were dead. They expected the Federal Reserve to finally pivot and cut interest rates. But they forgot about one man: Kevin Warsh, the newly confirmed chair of the Federal Open Market Committee. Warsh didn't inherit a stable economy. He inherited a shadow inflation rate running at a 3-year high of 3.8%. heavily driven by persistent supply shocks. While the public celebrated peace, Warsh was looking at the left side of the decimal point. The Fed's official inflation target is 2%. The reality? Total PCE inflation for the year is projected at a stubborn 3.6%. When the FOMC concluded its 4th meeting of the year on June 17th, they held the benchmark interest rate steady in the 3.50% to 3.75% range. That was expected. What happened next caught every single trading desk completely off guard. For 15 years, the Federal Reserve controlled the markets using a psychological tool called forward guidance. It was a mechanism where the Fed explicitly told the public exactly what they planned to do with interest rates months, sometimes years, in advance. Wall Street loved it. High-frequency trading algorithms were programmed around it. Institutional crypto capital thrived on it. The massive influx of capital into Bitcoin spot ETFs over the past 2 years was built entirely on the predictable trajectory of global liquidity. As June arrived, institutional adoption reached new structural heights. On June 15, 2026, Fidelity officially launched its government money market fund, specifically designed for stablecoin reserve assets under the newly enacted Genius Act, charging a 0.25% management fee to capture a piece of the $315 billion digital dollar economy. On the exact same day, BlackRock's chief investment officer, Rick Rieder, publicly announced that despite Bitcoin dropping nearly 50% from its absolute macro peak due to global liquidity tightening, the asset was bound to go considerably higher in the long term. At exactly 2 p.m. Eastern Time on June 17th, the FOMC released its policy statement. The vote to hold rates steady was unanimous at 12-0. But the devastation was buried in the dot plot, the chart tracking where each individual Fed official expects interest rates to go. In March, the consensus pointed to aggressive rate cuts, but the new chart revealed an aggressive hawkish shift. 9 out of the 18 voting members now projected at least one interest rate hike before the end of 2026. 6 of them had penciled in 2 separate quarter-point increases. The reaction was instantaneous. The 2-year U.S. Treasury yield skyrocketed by more than 16 basis points to 4.216% in less than 10 minutes. The algorithms realized the cheap money era wasn't coming back. But the true hammer blow came 30 minutes later. At 2:30 p.m., Kevin Warsh took the microphone for his inaugural press conference as chairman. A reporter asked about the Fed's future path. Warsh looked directly into the camera and dropped a bombshell that effectively rewrote modern monetary policy. He stated, "Forward guidance isn't the business we should be in." Warsh announced the immediate creation of a special task force on communications, explicitly designed to dismantle the Fed's practice of giving the market a roadmap. He wanted the Fed to be completely data-dependent. If the data changed on a Monday, the policy could change on a Wednesday. No warnings, no hints. For automated market makers and institutional spot ETFs, this was a worst-case scenario. Capital requires certainty. Without forward guidance, the risk parameters of every institutional desk in New York instantly broke. The machines began to de-risk. That afternoon, spot Bitcoin ETFs witnessed a massive $111 million net cash outflow. As liquidity evaporated from the order books, Bitcoin cracked. It cascaded through leverage pools, breaking down past $65,000, and bottomed out at precisely $63,939. The fallout was catastrophic for retail speculators. By the morning of June 18th, the crypto fear and greed index collapsed to a psychological low of 15, a level of absolute terror not seen since the depth of the previous bear market. Social media filled with panic as thousands of over-leveraged long positions were systematically wiped out. But while retail investors were panic selling their assets into the drop, the blockchain was recording a completely different reality. The public saw a crash. The on-chain data saw a massive coordinated wealth transfer. During the exact 48-hour window of this panic, long-term holder wallet addresses, entities that historically accumulate and hold asset supply for over 180 days, absorbed a staggering 125,000 BTC directly from the liquid market. The institutional narrative didn't break, it simply forced a liquidity sweep. The new Fed regime didn't kill the bull market. It merely shifted the ownership of the supply from weak, leveraged hands into the balance sheets of deep-pocketed accumulators who understand the true value of scarcity in an era of absolute macroeconomic blindness. The sudden liquidation under Chairman Kevin Warsh exposes a fundamental flaw in the modern investment thesis. Most participants are not trading the underlying technology or the asset's scarcity. They are purely trading the predictability of the Federal Reserve's printer. When that predictability is stripped away, the market panics. As a real market participant, the core lesson here is clear. The era of relying on the Fed to give you a 3-month warning before changing policy is officially over. When the headlights are turned off, survival depends entirely on asset architecture. Cannot afford to leave your capital exposed to the systemic risk of leveraged venues or centralized custodians who adjust their risk models on a dime. We are entering a highly volatile phase of structural rotation. Traditional assets are reacting to artificial peace metrics, while digital assets are absorbing the shock of pure, unadulterated monetary policy. This friction is exactly where the long-term wealth of this cycle will be generated. The infrastructure is integrating faster than ever, and those who own the underlying spots will inevitably dictate the next leg up. What do you think was the most shocking part of Warsh's policy shift? Let me know your thoughts in the comments below.